Well, it's a great pleasure to have another second presentation here in Tallinn today. The topic, it's called the topic du jour, the topic of today is financial repression. And explained, probably not very many are familiar with what financial repression is and means, and probably a lot more familiar with the war on cash. So let's go about it. What is financial repression? It is an economic and specifically a monetary policy of the government, the monetary policy of the central bank of very low or negative real interest rates for the purpose of providing cheap loans to the government. In other words, you try lending at 5% to the Italian government is going to be bankrupt right away. The Italian government has 1 trillion, so much of debt, to the point if they had to pay 5%, the whole government's budget will not be enough just to pay interest on that debt. At 5%, the Italian government is bankrupt. At 4, it is bankrupt. At 3, it is close to bankrupt. It needs to have it at 1 or 2% just to survive and just to service the debt itself. They got no chance of ever paying back the principal. It's like you're a teacher, you're making 50,000 euro a year, that's a big salary, and you owe 1 million euro, okay? And on 1 million euro at 4%, you're going to be paying every year 40,000 euro a year on the 50,000 of income. There is nothing left for you to live on. And if the interest is 5%, all of your income goes to interest. And if it's 6%, you'll never, ever be able to pay. All right? Well, that's Italy, that's England, that's US, that's pretty much all countries in the world. Okay, let's say in the developed Western world are like that. So they need the cheap loans, that's the one purpose. And the other purpose is if interest rates are extremely low, this generates a lot of borrowing, this generates a lot of inflation, and inflation and rising prices devalue, we say, inflates government debt. If the government owes, let's say, of Germany, 3 trillion euro, 5 years from now, 3 trillion euros will be a lot less, okay? Greece owes $300 billion. $300 billion will be worth, with good inflation, only 250 down the road, okay? So the purpose is, number one, keep service payments low and inflate the debt. So, what are the benefits? Let's summarize them quickly. Number one, cheap borrowing, what I was explaining so far, and easy and available credit. In other words, if interest rates are high, Greece will never be able to borrow a single penny. It will be impossible. But now Greece keeps borrowing and borrowing and borrowing. Next one, it inflates the accumulated debt. I already explained that. It stimulates consumption. You can borrow dirt cheap, maybe 3, maybe 4% to buy a car, to buy a phone, or to buy a house. It supposedly stimulates investment. If you're a small business, you can borrow at 4%. Not at 8 or 12. So they say, oh, it's great. You're a consumer, you can borrow cheap, or you're a business. It generates, and you're all living through for the last 5 or 7 years, a real estate boom, okay? And low interest rates are like the ultimate Keynesian dream. Keynesians love to stimulate consumption. They love to stimulate investment. It's like a drug addict or, a Schwarzenegger who just keeps shooting more drugs and getting pumped up, okay? But Schwarzenegger, what? We know, even though he was the biggest, strongest man in the world, he suffered heart attack very early in his life and had a ruined cardiovascular system, had to go through a whole bunch of operations, heart operations and surgeries and whatnot, young, despite the monstrous physique, okay? And the economy gets similar. It gets drugged up and pumped up, but at the core, it's weak. The productive investment is what suffers in the economy. And let's see what else. Well, let's take a look at the disadvantages. It destroys savers. You get 0.1% if you're lucky. Most get 0. It distorts financial market signaling. The bond market doesn't react as well. I already showed you some distortions where Italy borrows at a lower interest rates than the United States. Absurd, but that's part of it. Promotes risk-taking. How? Well, you want 4% return. There is not an investment-grade bond where you can get 4%. Impossible. Not under financial repression. You got to lend it to Zambia or Nigeria or some other poor developing countries, okay? So you got to go and take an awful lot of risk. Even a junk bond in Europe will pay you, remember, 2%, nothing. You got to take an awful lot of risk to get some return. It promotes leveraging. Hey, you can borrow at 1 or 2%, let's say a European corporation, borrow a ton of money, okay? So business leverages up. It promotes wild speculation. People borrow 0.5%, buy stock, borrow 0.5%, buy real estate, borrow 0.5%, do whatever, any kind of speculation you want to do. Next one, promotes bubbles. I made a nice little presentation about the stock market bubble and why it is worse than 99 in 2008. Real estate bubble already explained. The bond bubble I already explained. So this is a horrible effect, okay? Next one, promotes indebtedness. Everybody just gets deeper and deeper in debt, okay? Nothing really good about it. It creates an artificial boom and it provides a false sense of prosperity. People do in Bulgaria. I was surprised. That was just 4 months ago in Bulgaria. People in Bulgaria honestly, genuinely believe that the economy is strong, that it's healthy, that we're doing really well, and they can't see and comprehend that it's false signal from the extremely low interest rates. And my good guess is that you're having the same sense here in the Estonian economy, and it's only a false prosperity, okay? And crowds out private investment. In other words, government borrow and all the other stuff. Essentially, there is no genuine productive investment like mining or any real. It's mostly speculation. It's mostly real estate borrowing. All right, next. What are the mechanisms? In other words, how is it done? How do governments do it? Well, number one, capping interest rates, like ECB caps the interest rate like 0.5%. How they do it? They pool the money in and they keep it inside the economy and they lock in domestic investors. In other words, you're a mutual fund here, let's say in the United States, US mutual fund, or mutual fund Estonian in Estonia. It forces the mutual fund to have at least 50% of its investments in government bonds. If the mutual fund must buy the government bond by regulation, the mutual fund will drive the bond price up and the interest rates down. So forcing pension funds, mutual funds, insurance companies, banks to buy government bonds is a simple and easy mechanism to drive government bond buying up. bond prices up and bond yields or bond interest rates down. What else? Again, that's exactly what I was explaining. We call these forced treasury purchases. You force all the financial institutions to buy these. Next, capital controls, okay? You do not allow to people to get their money out of here and invest in China or invest in Dubai or invest in Bulgaria or invest in some other place. You lock in capital in the country. And now the capital in the country is looking for outlets. It stays in the country. So what do you do, guys? I mean, you keep it in the bank for zero? No. Okay, so we're going to do next. Buy real estate. Well, you buy one, you buy two, you buy three. Eventually, you got to buy bonds. Eventually, buy corporate bonds. In other words, as long as the capital stays in the country, it will find its way into the bond market and keep interest rates low. Finally, next one is inflationary expectations. You keep interest rates super low. People think, oh, I'm getting only 0.5% or 1% on my income, and at the same time inflation is 3 or 4%. I'm losing money. If I'm losing money, in other words, my money loses value at 3%, but I get barely 1%, I'll go and do something with the money. Buy stock, buy bond, buy real estate, buy something, right? And that drives asset prices up. But essentially, what it makes people do is you don't hold cash. You don't want to hold cash due to inflation. It's called flight out of cash. You do something else, but not cash. And again, the idea is that money's got to be at home, but there cannot be an escape valve. You know, your money's losing value, that's fine. Just like I have in my office in the university now, he's an Egyptian professor in finance. We sit together. He says, oh, no, we never keep Egyptian money because Egyptian money is losing value because inflation is high. We always keep it in dollars or we always keep it in gold. In other words, if the local money is losing value, let's say euro is losing value, you convert it to dollars. But if the dollar is losing value, you can convert to some more stable currency, maybe the Swedish kroner or whatever, the Norwegian kroner, or you're going to buy it in gold. So if the government wants you to keep government bonds, it must prevent you from buying foreign currencies, and it must prevent you from buying gold. In other words, you have no choice. You got to buy stock, bond, or real estate, nothing else. No, you can't just keep your money in other stable currencies or gold, okay? And in the extreme form, for the first time in financial history in any civilization ever, you get negative nominal interest rates. That was from 2015. Japan was one of the first to introduce them. Switzerland was second. Germany would follow. And now you pay money, meaning you give loan to the government, and you get less. Why would you ever do that? You just keep your money in cash. If you can. That's where the war on cash comes from. All right, so what's the purpose? I've already said it, summarize it. It reduces debt payments, that's fairly clear. The negative interest rates erodes the debt value. In other words, the government owes, but owes less. And the money loses value, so it further deflates or further reduces additionally the debt. In other words, the government wins twice, even 3 times in a row. This is really, really good for the government. It's really, really good for borrowers. But if you're a saver and a lender, it's really bad for you. And the savers are usually people like you and me. And the borrowers are usually the governments, big banks, and major corporations. So it's to their benefit for the loss of the common people and savers. So what does that negative interest rate and financial repression. What's the interpretation? What does it really mean? Well, it simply means a tax on savings, okay? You save $1,000, you lend it to the government gives you back 990, the government just taxed you 1%. It's just a pure tax. It's the same as an inflation tax. An inflation tax is when prices go up, okay? You get your $1,000 back, but now it has a purchasing power of 900 only. You lost 10% on your purchasing power, even though you got your full $1,000 back. And it's the same as like a hidden tax, like a stealth tax. People don't really understand it. They don't really know it. I mean, they feel they're losing purchase, but they can't formulate it. People don't understand, well, inflation. I do for a reason. I understand inflation because in 1993, 4, and 5, I lived through a horrible, horrendous hyperinflation in my home country of Bulgaria, which was remarkably similar to that in Russia. I saw how prices doubled literally in a couple of weeks. My parents and my family got completely wiped out and lost everything, okay? And I made it a point for me in my life not simply to live through it, for my family to lose everything through it, but for me to actually learn, study, and become scholar and student of inflation, okay? And that's what I devoted the last 30 years of my life, or 25 years of my life, on that part. So that's something which I understand because I studied for 25 years diligently. But most people don't really know and understand what inflation is about. As Keynes says, not 1 in a million understands inflation and its effects and so on. All right, so financial repression is not really a new thing. First of all, right after World War I, meaning between 2 world wars, it was a monetary policy of the governments because they have accumulated an extraordinary amount of debt after World War I to have a financial repression in order to alleviate the accumulated debts of Germany, France, Britain, and whoever else were main participants in the war. Of course, again, you have a financial repression after World War II to inflate the accumulated debt both from the World War II and the preceding Great Depression of the 30s. So that was a very long period, from 1945 all the way to the 60s. Well, that wasn't enough. Then in the 70s, they had to have another repressionary policy where interest rate may be 12% and the nominal they'll pay you is only 5, 6, or 7. So you're suffering a huge 5, 6, 7% annual loss on your current income and everything you had saved, okay? So, for example, if someone, and they gave these examples, someone was a millionaire in 1970. They earned income and interest and whatnot, and at the end of 1980, they'll have 1.1 million. That 1.1 million would have a purchasing power of $250,000. In other words, you lost 3/4 of the purchasing power of your money. Essentially, the government stole 3/4 from you through inflation, and you kept barely 1/4 of your own money, and that was for the 1970s. Post-2001, Greenspan slashed interest rates close to 0. That ignited the stock market real estate boom that led to the crash. But again, the post 9/11 was a massive, 1%, massive lowering down to 1% when inflation was 2 or 3%. So it resulted in a negative interest rate. Well, The crash came in 2008. Again, massive bailouts, huge amount of debt. Interest rates went down practically to zero. The range of monetary policy was 0 to 0.25. In the real world, most rates were pegged down to 0.1%. And if inflation is 2, 3, 4%, whatever it is, that's exactly how much you lose on your money. And of course, post-bubble Japan, an example will be the bubble in Japan went in the 80s. The bubble burst in 1990. That's 27, almost 30 years ago. And for 27 years, the Japanese central bank has held interest rates close and down to zero, while inflation was a little higher. And for 27 years, people are losing purchasing power on their money, despite the fact that they say that Japan has a deflation. Not true. They have a deflation in the stock market. They have a deflation in the real estate market. But when it comes to milk and cheese and gasoline or electricity, it's not really deflation. Okay? So these are some examples of the history. Let's summarize very quickly and very easy. If there is a deflationary policy, who are the winners and losers? Sorry, repressionary, I misspoke. Financial repression. You have bonds, bonds lose value because you're going to get your $1,000 back 10 years from now worth only half or a quarter. Stocks lose relative value. Stocks in the 70s could not keep up with inflation. Of course, cash is losing value during inflation. But gold is by far the safest. In any inflationary and repressionary environment, especially when interest rates are negative, keeping your money in cash and keeping your money in deposit is not worth it. You'd better just hold it in gold. Or, as it was recently, let's say from 2000 to 2008, and then again from 2011, you just keep it in real estate. Or you just keep it in commodities. In other words, you prefer in financial repression to keep hard assets, a table, chair, copper, zinc, gold, or real estate, land, hard assets, which no matter what the amount of inflation, a kilogram of rice is still a kilogram of rice, which you can eat, okay? A kilogram of rice cannot be deflated. And you lose on your financial assets. All right. Financial repression, I already mentioned, runs in two forms. One is negative real interest rates. That was the only way that was used historically until literally 2 years ago, where they give you 1 or 2% on your deposit and inflation is 5 or 6. In other words, inflation is higher than the nominal interest rate. So we got a negative real interest rates and cash loses value. But now, over the last 2 years, they've moved to negative nominal interest rates, which is, as I mentioned, Japan, Switzerland, Germany, and as I showed you before, about roughly $9 trillion of global debt earns negative interest rates, meaning the saver gets punished with a negative interest rates. All right, so what's the difference? The difference between this policy and that policy is cash. Here, cash loses value and cash is trash. And you don't want to keep cash because it's losing value. But if it's a negative real interest rate, now do you lend the government 1,000 and get 990, or you put the 1,000 under the mattress or in a box and you lock it up or a safe deposit box? The answer is you're better off, rather than lending to the German government and lose money, let's say minus 1%, just keep your money in cash. Well, the German government cannot allow you to do that. You will undermine the German government. It's like a crime against the government to do that. So the German government, as well as the American and any other government that has negative nominal interest rate, cannot allow you to have your cash and to keep it. So they want some way or another, to, for you not to keep cash. So what do they do? Let's see what did they do. So the war on cash becomes necessary when when interest rates become negative, because nobody's going to lend at negative interest rates. So holding cash now protects you. Okay, you can hold 100,000 or 200,000, whatever money you want. Cash is good for you, but it destroys the government policy. Okay, so somehow, some way, the government has got to make you reduce your cash. If you got 50,000, they say, no, 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 you cannot keep 50,000, got to keep less. Okay, well, and finally, somehow the government has got to make you put that money. You still have the 50,000, but now you put it in the bank, not in cash. Well, why would you put your money in the bank? Why would you ever do that if you don't have trust in the bank? Well, here's why. Well, let's first say a war on cash. This is exactly the same chart that I showed you a couple of hours ago, where there's absolutely zero negative interest rates. You see it was a little bit in 14, and then in 15, and then suddenly in 16 and 17, at this point, it's close to $9 trillion. So suddenly, over the last 2 or 3 years, governments desperately need to eliminate cash from people's holdings and to bring cash into the financial and banking system. All right, so what's the interpretation? Well, I already mentioned, if you own foreign currency, it will protect you, okay? And now domestic currency also protects you. So, what is the meaning of the war on cash? Well, war on cash is just an extension of financial repression. It's a heavier, more forceful policy of financial repression. It must extend to capital controls. It must extend its controls over foreign currencies. It must extend control also over domestic currency. And as I mentioned before, it must extend its control over gold too. So, the war on cash makes financial repression more effective, okay? And it also prepares for a monetary reset. In other words, within 3, 5, 10 years, and Jim Rickards, you should know this guy, talks a lot about it, if all the money is in the banking system and eventually the banking system gets to implode, governments can easily reset the financial system by introducing a new currency and then replacing the old currency, kind of like what Greece wanted to do, to introduce their own drachma and replace the euro, but at the exchange rate of 3-1, and essentially Greeks will lose 70 or 80% of their money. When they do a monetary reset, the idea is that people will lose 50, 70, 90%. Whatever the governments decide, you will lose, okay? And you can also lose your money through bail-ins, which is something that you also need to understand, is when the bank goes bankrupt, depositors will lose a percentage of their deposits proportionate to the losses of the bank. So the bank lost 20% on their assets, depositors will lose 20% on their deposits. So one way or another, if the money is brought into the banking system, you can force people to suffer the losses. But if you got your cash in the pocket or your gold in your pocket, they can't do that. If it's in your pocket, they can't force the loss on you, okay? Only on that money which is in the banking system, okay? So, how do they do it? How the government does it? How the government forces you to get your money into the system? Well, transaction limits. You want to buy a car for $12,000? You can't pay with cash. You got to put your money in the bank, and then you got to wire transfer the money to the seller. So it brings the money in. Of course, propaganda. They just say, you hold money, 50,000, you got to be a terrorist. Who holds these days $50,000, 50,000 euro? I mean, you must be a drug dealer, right? I mean, no person who is perfectly legal and safe would hold 50,000 in cash. It's only drug dealers, terrorists. You got to be doing something illegal. In other words, they brainwash people to think that cash is dirty and associated with some sort of a crime. You're probably evading taxes, right? So somehow, again, terrorists use cash. I've already written, oh yeah, criminals use cash. Yeah, tax cheats use cash, right? Common, good, honest people never do that, right? I mean, you just use a credit card. I mean, of course, if it's buying a coffee for two. And of course, inconvenient. They make cash very inconvenient to the point where you don't want to carry a lot of cash with you, okay? And of course, they make it extremely inconvenient by removing large denomination bills. Well, let's say the following. You're in South Korea, okay, and there's a lot of corruption going on in South Korea. I mean, and you want to pay the guy $1 million worth, okay? You think you can just carry a bag and give it to the guy? No way. The biggest bill, well, back for a while ago, was like $10. One bag's not enough. 2 bags are not enough. 3 bags are not enough. How do you do $1 million bribe in South Korea? How do you give a bag full of money, to the guys? You know how it's done? You go and give the guy not a bag of money. You give the guy a key to a car. And the car's trunk is full of money. All right, so the guy gets the car. He gets to keep the car. Doesn't matter. Oh, you drop off the car, whatever it is, with the key inside. He gets a trunk full of bribe money. So the idea is they remove large denomination. You want to stash in a house $500,000 worth €500,000. If you got now the 500 euro bill, you could do that with 1,000 banknotes. Just a few stacks of money. Now they're removing already the 500 euro bill, right? They're not printing it anymore. Soon they're going to phase it out. So you'll need 200s, and then 100s, and then 50s. Well, try stashing €500,000 with 50 euro banknotes. And now a bag it's going to take huge amount. So that's a very important way of doing it. And finally, fear. They tell you, oh, your cash can be lost, it can be stolen, it can just burn, an accident can happen. In other words, they use a whole bunch of range of techniques where they force people or induce them or convince them that it's for your benefit to use less cash. Like in which one of the best developed cashless societies today is Sweden. It has the highest number of electronic payments. Hey, you can use a phone for anything, use a credit card for anything. It's so easy and so convenient that Swedes carry the least amount of cash in the whole world. It works well so far until they realized that they were trapped. Let's see what else I got. Okay. I just throw a few transaction restrictions. Well, the EU's restriction is 15,000 EU-wide, and they are desperate to get it down to 10. Well, Spain is already ahead. You can't buy anything for 2,000 with cash or 3,000 with cash. They've done it, got it down to 1,000. Anything you want to buy, you got to put your money in the bank, and then you got to wire the money. Now, you're the guy, the seller. You want your 5,000 for the car, you got to take it out. What are you going to do with it? You can't use it because you can't make a payment for 2,000. So you got to keep it back in the bank. It forces you to keep the money in the bank, whether you're a buyer or a seller, okay? So that's very effective. France is doing the 1,000. Greece has gone one step. In other words, the worse the situation is, the lower is the limit. And even now, things are so bad that Germany is proposing a reduction, I think, from 15 down to 5, and they're fighting it. Let's see. I think I'm pretty much close and done. Okay. So war on Gold. Okay, so far I was talking about cash and war on cash and the need on cash. War on gold is not as intensive. Why? Everybody's using cash. 100 out of 100. But how many have gold? 1 out of 100. Probably 2 out of 100. So gold is not as important. So a war on gold is always a later stage of the game as war on cash. War on gold is just as necessary for the government. And governments do have a war on gold. And someone was telling me in 1934, FDR, President Roosevelt, banned gold in the United States for 40 years because it was a very effective way against their policy of currency dollar devaluation, which they did in 93 is actually the ban, 94 was the devaluation, okay? And gold becomes a true, genuine protection. In other words, these days, gold is your best protection against the financial repression that's been going on since 2008 or 2009. So the governments will have to eventually have a massive war on gold. They can just make it illegal. They can just tax it big time, okay? They can just do a whole bunch of range and techniques, okay? So what is it that they can do? Just prohibition, okay? You cannot own it. Or propaganda. Yeah, this is great. This is great. I had left with my brother, so I was in 1995 to 2004. I got my PhD in the United States in economics and in finance. And back then in 2001, 2003, I was buying some gold and some silver. And I left some silver when I left the United States with my brother, okay? And he's a physicist, highly educated guy. And eventually, you know, when in 2011, silver prices like went up 5 or 10 times, and I decided to sell. Say, hey, brother, go ahead and sell it. He wouldn't want to touch it. He said, no way. He's never going to go. He's never going to sell it. He's not going to do that. Only criminals deal with gold and silver. He's highly educated. He's got a PhD in physics. I mean, he understands perfectly the physical properties, phenomenal properties of silver, but he wouldn't touch it. He said, no way. I had to hire one of my closest friends from Ohio, drive all the way to Washington, D.C., pay the guy 5% commission to sell a big chunk of gold, and dribble it down to 5 dealers selling 5,000 each piece, because my brother wouldn't touch it because that's dangerous. He will look suspicious. Nobody will. In other words, governments brainwash people, unfortunately, like my own brother, who would think that this is something very unsafe. He would never, ever have anything to do with gold. I mean, no way he will ever touch it or consider. He doesn't want to be associated in any possible way with gold or silver. All right? That can flag him, that can get him in a database, whatever it is. In other words, that's how they do it, okay? And he's a very educated man, okay? It's not just some, next, price manipulations. They smash the price. People get scared about it. Ignorance. People just don't know. Gold is not studied anymore. In international finance textbooks, most of what they write and teach and educate people about gold is just dead wrong. People don't know it. People don't understand. It's not part of the education. Gold is not part of Western culture anymore. It's part of Arab culture and Indian culture and Chinese. In other words, it's part of Eastern and Asian culture, but not anymore part of Western culture and civilization. Of course, they can just plain confiscate it or nationalize it, or they'll just tell you, patriots don't hold gold. Patriots buy government bonds, okay? Only traitors do that. That's, of course, pure propaganda, but if it doesn't work, they'll just ban it and outlaw it. And this is just a simple example. It's the same chart I gave you a while ago as to why the governments are resorting to financial repression and to the war on gold. That's because debt's been rising and rising and rising and rising. Governments are getting to the point where 3-4% is next to impossible for them to pay. It's got to be one or two, or better, negative. And a conclusion, again, total global debt is still rising and rising. That's the previous chart. Financial repression is getting intensified. The war on cash is just beginning and will intensify. And the war on gold has barely begun, but once the war on cash is more or less won, they'll move on to gold next. So the war on cash is here now on, and the war on gold you should expect to come soon. And what's the recommendation? Simple. Hold gold somewhere outside the financial system, and preferably outside a safe deposit box in a bank. Yeah, you want to keep 5, 10, 15% in a safe deposit box in the bank. Okay, you got $1 million, keeping 50,000 in the bank, that's no big deal. But keep most of it, 80, 90% outside the financial system. And same thing, just hold cash outside the financial system. And that's my presentation, which I had. I hopefully was enlightening, and I hope that it was, you got to understand about it.